Welcome back. You're watching Markets at Lunch on ET Now, and clearly a good bounce back is what we've seen for the markets at this point of time. Nifty up in trade by about 0.8%.
Well, we're at the day's highs right now, Kamya, led just by private banks and individual names. Look at IOC, for instance, post the OFS, which got subscribed fully yesterday. You're seeing a big spike up come in on IOC. And remember, this move hasn't really come in throughout today's trading session. It's not been a consistent one. You've seen that spike come in only in the last 1 hour or so, where IOC has jumped up a nice 9% as we speak. BPCL, a 4% move is what you're seeing right now. And of course, realty stocks are really surging ahead. So DLF, Unitech, HDIL, they're all looking up in trade right now. Real estate index has been a big contributor today, but that would typically be the case. It was the most oversold too. But I'm going to bring on board Mayuresh Joshi, fund manager at Angel Broking, talk about what the market should be up to right now. And Mayuresh, afternoon, fair amount of choppiness right now in trade. Does it seem like this is how life is going to be, where every dip is going to get bought into and every spike up is going to get sold into? Or do you think perhaps a near-term bottom may have been made earlier today?
Afternoon, Aisha. Not really sure whether a near-term bottom has been made, because you're really not sure on the kind of data points that will come out from China over the next few months, or what action the central bank over there will take. Having said that, I think the current structure more or less is now well known because of the global rout and the emerging currencies creating a havoc. So I think India is not decoupled in that sense when it comes to global trade, and therefore we're seeing some amount of hit being taken on the currency as well, specifically with regards to how we are panning out over the next few weeks. But clearly I think we are in a different situation than we were in 2008, 2013. Our forex reserves are much better. I think we're in a much stable positions when it comes on that count. And clearly I think it is more driven domestically in our case. So yes, I think even on a domestic scale, I think a lot of the negatives are probably getting factored into in terms of weaker monsoons, logjam in parliaments, corporate earnings remaining weak. But again, I think specific sectors are looking pretty attractive at this point of time. I think the market men were waiting for such amount of corrections to come through. Now that it has, I think it's a good time to start chipping into the market slowly and steadily.
Okay, so Mayuresh, the big question really would be, where has value emerged in the market?
Afternoon, Kami. I think clearly if you look at the value pockets, private sector banks is something that we believe the story should continue even from the current juncture. Clearly, I think they're not affected by what happens on a global situation, specifically with what happens to China. I think it is more domestic driven at this point of time. And for the private sector guys, I think the credit growth has been quite stupendous over the past few quarters. Their exposures towards stress sectors are far lesser. And again, I think the kind of capital adequacy that they've got will drive balance sheet growth. So I think there are the three basic tenets based on which I think the earnings should come through. So I think private sector is where we believe the value should emerge over the next few quarters. Again, the assumptions are that the capex cycle has to resume sooner than later. And again, the presumption is that rate cuts will follow suit over the next few months and quarters. Having said that, I think even IT as a sector is something we continue to like. The kind of depreciation might act as a tailwind for IT companies when the EBITDA margins are concerned for the coming quarters. But clearly, I think the utilization levels are showing signs of improvement. You're also seeing client mining activities increase steadily over the past few quarters. A lot of the visa related issues and wage hike related issues have probably played out on EBIT margins in the quarter gone by. So the constant currency growth, both in dollar and rupee terms, should be quite reasonable in our opinion over the next few quarters. And again, I think from a valuation perspective, comparing IT and pharma, I think the price earnings band that they trade between 14 and 19 and pharma trading between 25 and 27 times makes IT far more attractive. But again, I think selective pharma stocks have corrected in this massive correction. So I think selective pharma stocks are also looking pretty attractive.
Mayuresh, the other big question today we're asking is, should one avoid FII-dominated sectors, the likes of financials, IT, or for that matter, pharmaceuticals? I mean, are those the pockets where one profit takes and puts money into some others,
So So clearly, I think we're liking a mix of themes, Ayesha, at this point of time. As I mentioned, I think the private sector banks or banking as a pack generally should do reasonably well, assuming that the credit cycle turns and you've got a better macro environment happening. So I think IT banking is something that we'll continue to like, I think, irrespective of whether FIs are holding on to that or not, because we believe that the earnings visibility for both these sectors spread over the next 2 years is quite robust, specifically considering the way India is positioned at this point of time and the macros that we are dealing with. Subsequently also, I think the domestic cyclicals apart from banking should gather pace. So I think once the order activity starts happening on the power side, road side, a lot of the players, whether directly associated or ancillary companies associated with these sectors, should do well. But again, I think the time horizon has to be well laid out from the current levels. I think at least a couple of years in terms of how growth will pan out, because I think for earnings to start coming through will take at least a couple of quarters, and again I think one really starts discounting FY17 earnings only by the end of Q3. So clearly I think on a 2-year time horizon, even domestic cyclicals selectively appear quite attractive. So I think nibbling on all these sectors in durations over the next 2 to 3 months, I think will also reduce the impact cost of investors.
Right. Mayuresh, you did mention India is far better placed than the other emerging markets. Would you say that India at this point of time is the best bet under the current global market scenario?
So structurally, Kamya, I think India is probably one of the better bets from a long-term perspective. Clearly, I think the other economies are more commodity-led, and again, I think the variations in terms of how the earnings outlook happens overall for the economies depend on how their respective commodities perform. So Brazil, Russia more dependent on oil, and even if you look at the decimation that the other emerging currencies had, the Malaysian ringgit, the Indonesian currency, the Thai baht, I think clearly, and comparing them with the long-term averages, I think India is better placed, and specifically with the kind of correction that we've seen. And again, I think a lot of emphasis has been laid on the kind of reform measures that will come through, which in my opinion should start coming through. I think yes, you did see a logjam in Parliament, key bills probably not getting passed in this session, but some breakthrough might come through over the next few sessions in Parliament, and that might have some amount of headway as far as the Indian story is concerned. So clearly, I think from a structural perspective, the Indian story exists, but from a short to medium term perspective, I think we will have pain as the global markets suffer, the currencies suffer, and we are not decoupled in terms of how the global trade will pan out.
Mayuresh, what would you not buy into right now, even if there is a strong recovery? For instance, you're seeing realty stocks really spike up. Would you be a buyer in that uptick today? Would you at all recommend metals, or would you, stick it out with IT and pharma, as your opinion has been?
So clearly, I think on the metal side, highly commoditized business, you're not really sure when the cycle will turn for these guys. And yes, the expectations is that realization should start improving, but you're not really sure on how the data will come through. The realizations are weak, the supply is far greater than what the demand is coming through. You're already seeing that through utilization levels across plants, and clearly they are taking a hit on their EBIT margins along with the kind of leverage that a lot of these metal companies have. So I think purely in terms of what capex that these guys have done, demand not coming through, realizations weak, I think we'll still wait for the commodity cycle to start showing some signs of improvement. Similarly on the realty pack, I think it's a similar story panning out. Inventory levels pretty high for most realty players. Again, the kind of leverage that they have on their books and demand not coming back the way one was really expecting or anticipating, I think that is creating some amount of issues as far as the cash flows are concerned. So yes, I think at this point of time, I think it's an avoid on metals, it's an avoid on realty. And again, I think even on the FMCG part, I think the gross volumes might expand on a quarter-on-quarter basis, and the gross margins might expand. But clearly, I think how the monsoons pan out, how rural discretionary demand holds up, will be key in determining how their earnings pan out. So being extremely selective even on the FMCG pack at this point of time.
Mayuresh, a lot of experts are of the view that it's the best time to go stock picking. Would you also have a similar stance? And if yes, can you recommend some stocks?
Well, yes, I think a bottom-up approach is well needed at any point of time, and specifically in situations like these, you probably need to look at companies where the earnings visibility should be reasonably better compared to peers, and where the valuations have not exceeded their price expectations. So I think we did like as I mentioned, from the housing finance pack, LIC housing, and again on the sharp correction that we've seen, we continue to like that story. The cost of funds have come down drastically. The asset quality is quite stable for this company, and our take is that even at the current juncture, the valuations are not too expensive. Similarly, I think I'll wait on declines for mid-cap cement companies, where we believe that the long-term story should pan out. The realization should improve over the next few quarters. The volumes are stabilizing, and the volume growth would happen once the infra and the housing pickup starts happening and the capex cycle resumes. And we are assuming that to happen only after the next couple of quarters. So I think FY17 earnings will be far better for a whole host of these cement companies. So any decline on a few of these mid-cap cement companies like JK Lakshmi, JK Cement, I think it becomes a good buying opportunity for long-term investors with a couple of years time horizon.
Mayuresh, good chatting with you today. Thank you so much for taking the time out and speaking with us.
Thank you so much.
That's the view from Mayuresh Joshi from Angel Broking. Take a look at the currency volatility, and now after